Here's a financial industry power play that's about to reshape how America's wealthiest manage their money, and it might not be the democratization you'd expect. In a move that signals a massive consolidation in wealth management, Citi Wealth has just handed over the keys to approximately $80 billion worth of client assets to investment giant BlackRock. But here's where it gets controversial. This partnership might actually be creating an even more exclusive club for the ultra-wealthy, while everyday investors get left further behind. The announcement, made public on Thursday, September 4th, reveals that BlackRock will now be managing investment portfolios for thousands of Citi Wealth clients through a new program called Citi Portfolio Solutions powered by BlackRock. For those unfamiliar with the wealth management world, this is essentially like hiring a world-class chef to cook exclusively for your private dinner parties. Except in this case, that chef is one of the world's largest asset management firms, and the dinner guests are people with millions to invest. Andy Sieg, who heads up Citi's wealth division, didn't mince words about their ambitions. We want to bring best-in-class advice, solutions, and service to our clients. And we want to serve more of the world's changemakers. Notice that term, changemakers. It's a polite way of saying people with enough money to literally change the world, which raises an interesting question. Are we witnessing the creation of an even more powerful financial elite? But here's the part most people miss. This isn't just about moving money around. BlackRock will be deploying what they call core, opportunistic, and thematic investment strategies across multiple asset classes, including stocks, bonds, multi-asset approaches, and eventually even private markets. Think of it as having access to investment opportunities that regular folks can't even see, let alone participate in. The technical backbone of this partnership is BlackRock's Aladdin Wealth Platform, which sounds like something out of a fairy tale, but is actually a sophisticated technology system that provides advanced risk analysis, portfolio management, and data insights. For Citi's private bankers and investment professionals, this is like upgrading from a calculator to a supercomputer. It gives them capabilities that smaller wealth management firms simply can't match. And this is the part most people miss. The timing of this announcement is absolutely fascinating. On the exact same day, Merrill and Bank of America rolled out their own exclusive program called the Alts Expanded Access Program, specifically designed for ultra-high net worth clients with at least $50 million in assets. Coincidence? Hardly. This looks like a coordinated effort by major financial institutions to create even more exclusive tiers of service. But here's where it gets really interesting and potentially controversial. Recent research from PYMNTS Intelligence has uncovered something that should make everyone pause and think. Even high-income earners, people making $100,000 or more annually, are increasingly becoming what researchers call reactors, individuals who manage their finances on an as-needed basis rather than through strategic planning. The numbers are startling. As of January, 52% of these higher earners now identify as reactors, compared to just 27% in February 2024. This represents a complete reversal of traditional financial behavior patterns. Historically, people with higher incomes have been associated with proactive financial management. You know, the kind of strategic planning, consistent debt repayment, and healthy savings habits that financial advisors always preach about. So what's driving the shift toward reactive financial management, even among the affluent? The answer isn't pretty. Economic uncertainty, driven by persistent inflation, geopolitical tensions, and fluctuating interest rates, has created a climate where even well-off Americans are adopting a deal-with-it-when-it-happens approach to money management. This creates a fascinating paradox. While financial institutions like Citi and BlackRock are creating increasingly sophisticated and exclusive wealth management services for the ultra-rich, a growing portion of high earners are actually becoming less strategic about their financial planning. It's almost as if the wealth gap isn't just about money anymore. It's about access to financial sophistication and planning resources. Here's a controversial question that nobody in the financial industry wants to address. Are partnerships like the Citi BlackRock deal actually making wealth inequality worse by creating even more exclusive financial services for the already wealthy? While the broader population, even high earners, becomes more reactive and less strategic about money management. Think about it. If you're managing $50 million or more, you now have access to BlackRock's institutional-grade investment strategies and cutting-edge technology platforms. But if you're just making $100,000 a year, you're increasingly likely to be managing your finances on a reactive, crisis-by-crisis basis. The implications of this trend extend far beyond individual financial planning. When even affluent Americans are becoming more reactive in their financial approach, it suggests that broader economic uncertainties are creating a ripple effect that touches every income level, just in different ways. So here's the question I'll leave you with. Is the financial industry's push toward ultra-exclusive, technology-driven wealth management services actually helping create a more stable financial system? Or is it simply widening the gap between those who have access to sophisticated financial planning and those who don't? And more importantly, what does it mean for the average person trying to build wealth in an increasingly uncertain economic environment? What's your take? Are these exclusive partnerships between major banks and asset management giants a sign of innovation and better service? Or are they symptoms of a financial system that's becoming increasingly tilted toward the ultra-wealthy? Drop your thoughts in the comments, because this conversation is just getting started.